Welcome to the Daily Update, where I'll go over the action in the market from Monday, April 28th, and we'll see how things look for Tuesday, April 29th. Kind of a sleepy day in comparison. It's kind of nice that we're slowing down, though, and maintaining the gains that have been captured, at least to this point. And there's some big economic reports and earnings reports that are going to be coming out throughout the week. And so the market probably wants to just sit back and wait and not deploy a lot of funds ahead of those things actually happening. And then with the tariff news, that could break at any time and it could be either positive or negative. So you still have an apprehensive market, but it's climbing a wall of worry. One thing on the positive side, over the weekend, I checked out a few of my usual perma bears. They're very bearish. That's good because we use them as contrarian indicators. So if they're predicting doom and gloom, then that could be positive. But at the same time, we have to be realistic and not forecast. Okay, where are we right now? And we're still getting a mixed picture. Most of our primary indicators are positive except for one, and that's what we use to measure and look at the condition of the trend. That is still negative, and that's the average directional movement that I'll show you a chart of. But we're holding up okay. We're not seeing an awful lot of selling into this strength. We didn't see a lot of follow through buying, even though we had a bit of a positive close. And growth didn't really have that good of a day, where we need to see that outperforming value if we're going to switch back and be more positive. Okay, so right at the open, we had pretty much a flat open. Now, the futures were negative. They opened Sunday evening and they gapped lower, and we were down about a 0.5% or so as we worked our way through the overnight session. We saw some improvements, and Europe was having a fairly good day. That helped give some support to the S&P futures, and then by the time we opened, we were pretty much flat. And right after the open, though, we did see a little bit of buying, but we hit resistance right at R1 at 55.50. That's becoming kind of a important level now. That's right around the level where things started to fall apart when we were going down. We're still at the top end of this range as we've been bouncing back up, and it's like we've been in a big box lately. Well, we're at the high end of that box right now, so we'll see if we're able to break above that. We are looking a little toppy in the short term because we had a pretty good upward move. So we are not necessarily surprised by seeing this sideways action and maybe even some declines. If we do see declines, what's the intensity of any selling going to be? Is it going to be a lot of conviction or just pulling back, maybe some profit taking that's taking place? But then we declined back below the unchanged level in the daily pivot at 5503. So we're right around that 5500 level too. But then we dropped down to S1 and it looked like we were going to break below S1, but we held on to that. And S1 was at 5478. So we dropped under 5500. But then later in the day, after the market open gets kind of dealt with, and then around lunchtime or so Eastern time, that's when the smart money comes in and wants to start doing what they're going to do. And prices were able to climb back above the daily pivot, the unchanged level. So we went positive and we ended up closing slightly positive. We were up 0.06%. Again, virtually unchanged on the day. But because we were up, it goes in the books as an up day. And we're still below average with volume. We've seen that now as we've been trading around in this really crazy roller coaster range. We have an up day, we have a down day. There's a lot of folks just kind of stepping back and saying, okay, I'm not going to deploy a lot of money right now until things become more clear. We are positive in the short term because we're above the 20 period moving average, but we're still negative in the intermediate and long term. Interest rates did decline, and that's helping give some support to stocks. We're seeing last week and so far in Monday's session, the bond market seems to be more under control. The dollar is still declining, and that could actually benefit stocks. But at the same time, we want to know, why is the dollar declining when with all the tariff talk and these protectionist mechanisms that are trying to be put in place, that usually helps a currency to go up. And we're actually seeing it coming down. So We're just kind of keeping an eye on that area as well. No real concrete news other than just little stories here and there coming out of the trade wars and tariffs and things like that. Okay, so just some comments. It was a relatively calm session ahead of major economic reports and earnings reports that are due out. Mega caps and growth didn't really have all that good of a day. Didn't have a terrible day, but didn't really show any strength. And there is a Zweig NYSE Breadth Thrust. Now, I would probably take away the word debated after I went through and looked over the weekend. Um, it's not debated. It's there. And you don't just, the debate was that, well, this was just caused by short covering. And yeah, there's some of that that plays into it, but you don't see a really strong signal like that that's pretty rare just based around short covering. So I pretty much I double checked the numbers and everything, and yeah, it's a valid Zwag NYC breadth thrust, and I'll show you that chart here in just a moment. We are back above 25, even though we had the slight up day. We had dropped below 25 after Friday. We're back above 25 at 25.15 after Monday's session. And then we have our usual indicators here in the short term that suggest we're seeing positive momentum, and we're actually looking a little extreme right now with this. And that's why some kind of sideways to downward action could be justified as long as it doesn't get too intense. And this includes the StochRSI, the Williams percent R, the CCI 14. The CCI 20 is not on the list yet. That's usually on here when we're seeing good momentum. The stochastics, the rate of change going back 5 periods, and then we're still far away from the 20-period moving average. We had been far away below the moving average. Now we're far away above the moving average as we've been bouncing back up. Intermediate term, we still have the CMB composite. That's looking extreme positive. Not the S&P, but the NYSE McClellan Oscillator is extreme, and that's actually helpful. It could still go up from where it's at right here. We just pay attention to it more when it gets above a certain level because it's looking extreme. But the NYSE, that's broad. That's more broader than the S&P is, and so to see that holding up fairly well is encouraging. We have one of our PMO studies that is looking extreme. The bullish percent index for the NASDAQ 100 is looking extreme. And we're right on the border here with the advanced decline oscillator. And I'll show you all these charts here. No changes right now to the overall scenario as it concerns the Fed. They're worried about the economy slowing down and inflation going up. That's kind of the last thing that we really took from them. The dollar does continue to decline. Interest rates are down. We were at 4.27% after Friday. We declined down to 4.22% with the 10-year yield after Monday. And sentiment is actually improving. Now it's negative overall. That's when you just look at the number by itself. We look at the context, and we were down well below 25, and we've been coming up from that 25 level. And so that's actually showing some improvement there. We're still inverted with the 10-year to the 3 month. Now, I pay attention to that more than other folks. Most people watch the 10-year to the 2-year yield curve, and I watch that too. But I also keep an eye on the 10-year to the 3 month. And for a couple of trading sessions now, it's been inverted again, which is kind of a warning sign that once it goes back to being regular, that's when we're like, okay, this is usually when we start looking to see if we're going to go into a recession. Now, both the 10-year to 2-year and 10-year to 3 month, they went inverted for a couple of years while we were fighting this whole coming out of COVID thing. And usually, after they go back to being normal, that's when we likely go into a recession. It didn't happen this time, and it may not happen this latest time either. We have a lot of different charts, and on the website that I have, I do update. I'll probably update it next week because a lot of that data that we use to see if we're going into a recession or not comes from the employment data. And we'll get jobless claims and continuing claims on Thursday. We'll get the big employment report on Friday, and then that's when a lot of those charts will be updated. And this is the holdout though. We're still negative with the ADX. It's the average directional movement. It's what I use to look at the condition of the current trend, and it's negative right now. The red line is still above the green line, where a lot of our other indicators are positive right now. And we had just a slight up day. So yeah, you could call it mixed, but since it was an up day, it's positive. And then momentum, I'm keeping it mixed to positive. Until we break out of this range or break down in this range, it's really hard to get a conviction that goes over 2, 3, 4, 5 days that's somewhat you have confidence in that overall conviction. That's why I'm saying mixed right now, because we're still in that range. Okay, we didn't have any economic reports on Monday, so there's no charts to show you here. I didn't get this from Isabel Net. This is actually from Dan Bird, which is a free email that you can belong to. And it's just he's trying to compare, okay, 2022, that was a cyclical bear market when we were really going down. And then he, over top of that, he has in purple, that's what happened in 2022. And so far, what's been happening in 2025. Uh, I look at these charts, they're interesting. I don't use them to make decisions. It just gives us a little bit more of a context that we started off 2022 looking pretty good. We set the all-time high with the S&P and then really started to decline after that. And there are rebounds along the way. And so we'll have to see. Are we going to stick to a similar pattern to what we saw back in 2022? It's kind of close, but not exact. They're never exactly the same. Looking at the weekly version of it, it's a composite sentiment gauge here. We're coming in at 42.79. We're way over here, well, actually here in the fear area, where they have it as green. I would have it as red. So hey, I would change the colors there. But we're considered neutral. But this is a lot of different sentiment indicators taken together. I don't use this one as much, number one, because we only see it once a week, and sentiment can change quickly. That's why I use the daily charts. I use the fear and greed index that I get from CNN Money. And we're down here in the fear area where this is more neutral, according to this. And then just to give you an idea where we are on a valuation basis, after Friday, we were right at 20. Now, this is looking forward, and that's what the market uses. So we're right at the upper end of that 10, 15, 20 scale. When we go 20 or above, that means we're starting to look expensive. And then that's what I focus on the most. But then you can see inside of the S&P, the different sectors and what their current PE ratios are. And even after it's been declining, discretionary is still the most expensive with tech. Then staples have been coming on strong. They're looking a little expensive right now. Energy's way down at the bottom, and you have communication, which is under that 20 level. So this gives us a little bit to compare to with what are the individual sectors looking like on a valuation basis, and then looking at the bigger picture of the S&P 500 itself. Then here's the insider transaction ratio, and I always say this, it's legal insider transactions. Actually coming up back here to the black line. If we keep going up here, that would be more bearish than bullish. And then buybacks, we're starting to hear a little bit more about that now. So the announcements through the first quarter, they've been pretty strong. And that's seen as something positive. When a company's willing to take its money and go into the stock market and buy back some of its own stock, that's seen as a vote of confidence. And it also removes a number of shares from the marketplace, which makes each share more precious. And so from there, you then have the ability to say, okay, there are fewer shares, so they might actually be able to go up in value. So that's usually seen as something pretty positive, and the market tends to like it when we see a lot of buybacks, at least announced. Now, it's one thing to announce a buyback, it's another thing to actually do it. So we'll just have to see how this goes forward as the market goes up here, if it keeps going up. And then discretionary investors, they've moved their positioning dial towards different areas now where you look at the discretionary. Now, this doesn't mean discretionary sector. This is people that watch the market and they try to time the market a little bit more. So they have the discretion of getting in or getting out versus a systematic strategy, which would be like dollar cost averaging, or you put in a certain amount every month and you stick to a system and you don't really pay attention to what's going on in the market. And this tends to really underperform when we're really going down and the indexes are really moving. And so a lot of the folks that are more discretionary, they got out. And so now they're starting to buy as we're going back up. So they actually tend to perform better. When we're in a more solid uptrend, the systematic strategy tends to work better. But when we're going down, discretionary tends to work a little bit better there. And we see that same relationship between managed and non-managed mutual funds and even ETFs. If you just leave those alone, like an index fund, it does great when the market's doing well. But the managed mutual funds and ETFs tend to do better when we're under pressure because they do some maneuvering and they can protect themselves or get out of investments that are really going down with some conviction. Weekly flows into crypto. So we're seeing a lot of money going back in as we're getting back up into the 90,000 range. We'll see if we can get above 100,000 and stay there this time if we keep going up. Even though you look at Bitcoin itself, I do track that one and it's in a downtrend, but we're bouncing up from lower levels, even though it is showing a moving average downtrend right now. And the financial conditions index, excluding equities, it's coming down a little bit here, and this is also dropping. So this just means that a little bit more money is out there available. And so this actually could end up being positive for the market. Implied probability of a recession, and I don't know how they calculate this, but it's about 50-50 when it comes to the S&P. And then across bonds and different classes here, the Russell 2000, that's kind of, those are the small caps. And they're kind of with the highest percentage now that we're likely to go into a recession. And that's the fear of that is one of the reasons why the small caps just have not been doing well. And they've actually been leading more to the downside. Then valuations are still above average, and I kind of went through that a little bit. And I do go over this in the weekend video when I do the intermarket analysis video. I mostly look at the S&P 500, and we're right at that 20 level. And this is looking forward. I look historically, but that's not what the market uses. We use that more for context. We're looking forward, that's based on projections and forecasts. And as we've been coming down, we got back down to 20 with the PE ratio. But if we start going back up, we're going to go back above 20 again. And then this is from a different source too. It's hedge funds and staples. You look at the hedge funds out there, and they've been really selling staples a lot lately. That's kind of the takeaway from this chart. And then the 12-month forward PE, if we really start going down the trough, that's the bottom. What is the PE ratio like when we're really declining? And I'm not going to go through all of this. This is more the market overall in different times when we had bear markets and when it was most severe, and then where we're at currently. And you could debate that some of these, like this has it at 13.3. Well, I have us at 20 based on the ones that I look at. So there's different ways of looking at this, and then what the PE ratios were when we finally hit bottom. Okay, so kind of a sleepy day here, pretty much a flat open. We did get up to R1, then we dropped down, went negative, dropped below the daily pivot. That's the solid blue line. But we were able to establish some support here at S1. There was a couple of times we tried to break a little bit lower, but that didn't last too long. And then after lunch, this is when the smart money came in and they started to buy. So we got back above the daily pivot. We actually got above the unchanged level to close slightly positive on the day. So not really positive, but not negative either. And here's the intraday chart. Not seeing much of a change in the initial overnight session going into Tuesday. This is still a little bit encouraging. We're seeing the blue line above the red line here. This is the intraday growth of value. And we want the blue line to be above the red line. When the blue line is outperforming, that's when the market has more of a tendency to go up. That means growth is outperforming value. And we did fall back here a little bit, but we saw a late day recovery here. So I'm keeping this area green for right now because the bigger context is we are going back up. And that's what we want if we're more positive on the market. But the end of day charts here, growth was up just 0.01%, where value was up more. So growth did underperform. For the mid caps, growth was down where it was up with value for the mid caps and up less for the small caps. So seeing some bigger picture improvements here with the small cap growth to value ratio. We're above the moving averages, but overall the end of day chart did decline. declined a little bit here with mid cap growth to value. We're back above the moving averages. We're in a downtrend here, and we're back above the 50-period moving average, but we haven't been able to get back above the 200-day moving average. This is the one, if you follow the S&P 500, that you track probably the closest, and it's improving, but we want it to see it go above both of these lines, stay above these lines, and eventually turn this trend for this ratio back up. And we're still kind of at the underside of this rainbow when we look at this growth to value ETF study. And discretionary is in a downtrend, even when we look at it on an equal weight basis. Staples have been holding up a little bit better. We're seeing a death cross that was triggered late last week when we look at the discretionary to staples equal weight ratio, since we're underneath both the moving averages. And that's more negative. We want discretionary to outperform and see this go back into an uptrend to be more positive. And then looking at just the discretionary weighted versus the staples weighted ratio, that has been coming down. And this is when the market's been getting more defensive, but we are seeing an attempted bounce here that's still continuing. We saw this going from Thursday, Friday, and then even after Monday's session, there's still an attempt at a bounce, but we really haven't broken out of this downtrend that we've been seeing here. This is the equal weight ratio that I just showed on the previous chart. It's trying to improve, but still in a downtrend. And then we look at tech, which is growth, to utilities, which in this case is considered to be value, trying to improve, but still in a downtrend. Biotech, which is growth, versus healthcare, which is staples or more defensive, trying to improve here, but still in a downtrend. And then hotels, which is discretionary, versus utilities, which is something that you have to have, trying to improve here, but still in an overall downtrend. So there are some improvements coming in. We just need to see more conviction and these charts continuing to go up to be more positive. And looking at the bellwether areas, the semiconductors are trying to bounce back after being in a downtrend, as are the home builders. They're kind of chopping sideways right now. We're seeing some weakness again here, just kind of chopping sideways to a little bit lower with the transports. Retail trying to stage a little bit of a bounce here, as are the regional banks. And then looking at retail, the top area is a ratio between retail and the S&P. When this is going down, that means retail's underperforming. And then we look at the chart of retail by itself, where it is in a downtrend right now, trying to get back up to its 50-day moving average. And we're just a little bit above 50 with the RSI. So it's showing some slight positive momentum there. And this is where we're still negative. This is the intermediate term ADX indicator. And this is kind of my main indicator, where we have the red line above the green line. That means we're negative. Now, this is a weakening trend because the ADX is coming down and it's below its moving average. This is not, it doesn't measure direction. This measures how intense or how much strength is there in the trend. And when this is coming down below the moving average, that means the trend is weakening. So if we do see some more follow through here, and see we're right battling this 55-50 area here, kind of at the low end of where things were holding up before they really fell apart. If we do break up into that area, at some point, this indicator should turn positive. Of course, if we start falling down from here, then this indicator will stay more negative. This is short term as well, where we're still seeing the trend weakening with the ADX going down, but it's negative because the red line's above the green line. And if you watch the weekly video, we're negative with a strengthening trend on the weekly chart. We continue to be below average with volume here with our oscillator. This looks at it over a period of time, where this is more of a day in and day out look, and we continue to be below average with volume. We are coming down a little bit with the Ulcer Index. This is another fear gauge, but we're still above this moving average. And we're back above 25 now with the VIX, where after Friday we were a little bit below 25. Now we're back a little bit above 25. Whenever we're above 20, that's when the market is more concerned. And the VIX of the VIX, the VVIX, it's actually declining below the moving averages, but it did tick up a little bit in Monday's session. But the momentum for the VIX, after we were really going up, it's coming back down here as measured by the MACD. It shows the momentum for the VIX is down now, which is more positive for stocks. And we ticked up just a little bit here with this one fear gauge, and we ticked up a little bit here, but not much of a change. We're not really seeing an awful lot of conviction after a Monday session. And we came down a little bit, but we're trying to see an improvement here with the risk on to risk off ratio. If this is going up, that's more positive. Or if this ratio is going down, that's more negative, meaning folks are becoming more risk off, getting out of the high beta stocks and getting into more conservative stocks that hold up better if we're going down. And we came up a little bit here with the daily chart of the equity put call ratio. We're still going down with the 5 day, and we're actually starting to get to an extreme negative reading. When it gets below this red line, that's when we pay more attention to this. And we're ticking up a little bit here with our 10 day. So we're seeing a bit of a discrepancy there and still getting a very low reading with volatility risk premium. And that we've seen that continuing to decline as of late. The advanced decline line is still looking positive. The mix that we were seeing is that volume dropped below the moving average. Well, it's still above the moving average, and we actually went up a little bit here based on price. So this is more positive since we're above these advancing moving averages. And we were just barely getting extreme here with our advanced decliners over a 10-day period. We backed off of that slightly in Monday's session. We're positive with the short and intermediate term advanced decline ratio. Both these lines are above zero. And this is, I've been pointing this out every time I show it here. The 5 day and the 10 day are going up, but it's not that we're seeing a strength in new highs, it's that we're seeing a contraction of new lows. So this is like deceptively looking stronger when it's really not. We need to see the green really start to move up and the red to stay more under control here. We are positive with our three smart money indicators. We're above the moving average with accumulation distribution. We're positive with smart money indicator number 2, the Chaikin Money Flow, and we're above the midpoint and going up with smart money indicator number 3, the Chaikin Oscillator. So that's positive. And these, the reason I call them smart money indicators, these not only look at price, they also calculate with volume. And if there's a lot of volume, that tells us that the smart money is in there doing a lot of buying. And we're positive with the vortex. We saw a crossover positive last Thursday, and that's continuing to show an improvement here. And we're still positive when we look at the advanced decline line for the S&P. We're coming back above the moving average with the NYSE common stock and mid caps. We're still below a declining moving average with the small caps. And this is improving. We're actually getting kind of an extreme reading here with those stocks in the S&P above their 20-period moving averages. That's good in the short term, and this is going up and above 50. But then the next chart, this is a study where when we get above 70, that's when we're starting to look kind of extreme here. And so we could still go up more than where we're at right now, but this is when we start to just pay attention to this a little bit more. And we are improving, but still negative with the 50-period moving average study, the 100-period moving average study, and the 200-period moving average study. They're negative because they're all below 50%. Then here is the daily chart showing that we are in a downtrend, even though we're not in a bear market. We're less than 20% down. We're back to around that 10% correction area for the decline that we saw from the all-time high down to where we're at right now, where we're starting to get close to that 20% level, and then we bounced up out of that. The rate of change going back 5 trading days, this is still looking extreme positive. A little bit of an improvement with the 20 period, 50 period, and even a little bit of an uptick with the 200 period moving average study. And this is showing good short-term momentum with the StochRSI, but we consider it to be overbought because this is pegged right at the top. And we're also coming down a little bit, but still extreme at the Williams percent R. The CCI 20, it's not up extreme yet, where the CCI 14 is. It's a little bit above this level now. And we're extreme and rolling over just a little bit with the short-term stochastic. We're extreme in the intermediate term, short-term stochastic. And we're positive above the midpoint and improving with our long short-term stochastic. We're still positive with the force index, and the condition of the short-term trend is improving. We're above both of these lines based on 20 periods, and the lines are going up, and that's improving there. And we're above the 20-period simple and exponential moving averages. So that's why we're back to positive now. And we're climbing further above the midpoint with our standard deviations chart. We're still in the +1 channel. It would show more solid momentum if we get into the +2 channel, and then it starts to get extreme if we go into the +3 channel. And the current reading from Trueflation is 1.55%. That's below the target rate of the Fed, but this is independent of the Fed. They have their own way of calculating inflation. So we're just using this as another source to see, okay, how realistic is this? We are positive, but ticking down a little bit with the balance of power. We're showing some improvement here with the bow tie. We're above all of these lines here, and the longer we stay above that, the more these lines start to turn up and show some improvement. And this is where we're 10.02% away from the closing high set on February 19th to where we closed on Monday. So if we go up from here, we'll actually be out of correction territory and going back into just decline territory. And we're still looking just a little bit extreme here with the CMB composite. We're above this black line. We're still seeing a lighter shade of purple here, which is more neutral, but still negative since our purple. If these bars turn back to blue, that's when we're positive. And we're coming back above the midpoint, and we're starting to see the highest high value, which is the blue line here, starting to turn up a little bit. And we're still seeing the lowest low way down here. And we are turning more positive with the TTM squeeze. Excuse me here. That's a momentum that is quite popular with some folks here. So it's turning blue and looking positive there. We tick back up a little bit with standard deviation. This measures speed, not direction. And with the big thrust that we saw mainly last Thursday and then a follow through on Friday, it's turning the standard deviation up a little bit and we're above the moving average. And we're positive and really going up. And after being extreme negative, the ease of movement, it could be suggested that we're getting extreme positive here. This tries to measure the path of least resistance. Well, right now that least resistance is up, but maybe we've gone up a little too far according to this chart. We're still flat with the Arun. It's not really picking up much of anything. And the S&P McClellan oscillator did tick back up. It's not extreme. We're not above the 60 level, but we are above zero. And when that's above zero, the summation index based on price goes up, and we're above the midpoint and going up based on volume. So this is still positive here. We're extreme just a little bit here with the NYSE McClellan oscillator, which could be positive because it's more broad based. And we're going up with the summation index for the NYSE based on price and volume. And we're going up with the Swindle Trading Oscillator based on price and volume. If we continue to go up, we will hit this red line. A lot of times that means we're getting extreme positive. And we are seeing an improvement here with the PMO. It's turning up and finally coming back up to this green line, which when we drop below this green line, that's when we're extreme negative. So we're just improving, but we're just coming back to where we're usually extreme negative here. But we're positive based on price, and we're crossing above the midpoint based on volume. This is the extreme reading here with the PMO studies. With the PMOs that are rising, we're getting above this green line, but it could still go higher, but probably not much higher than what we're seeing right now. But the buy signals continue to be positive, and we're seeing a slower improvement here with the PMOs that are above zero. And these are all of the price momentum oscillators inside of 503 stocks that make up the S&P 500. The condition of the intermediate term trend is still negative but improving. And I use this study to show that when we get above these lines and we're starting to turn back up, it's looking better. But when we look at all the moving averages here, and this looks like spaghetti, we now are going to be, if we go up, we're going to be bumping into the 50 period exponential moving average. We haven't hit that yet, but not a lot of folks use that, but I plot it because sometimes the market uses it. And we might hit this as overhead resistance, and we have a lot of moving averages here that could cause some overhead resistance if we try to go up. And we're far away from the 20 period moving average. We're getting an extreme reading with the boom indicator, improving, but still below zero with the 50 period boom indicator, and still below zero with the 200 boom indicator. We're positive with the Elder's Impulse system for the S&P, and we're positive with the parabolic SAR since the dots are underneath. We're still negative on the weekly chart, though. And we're positive here. Short-term oscillator slope coming back up above this red line. and we're actually coming up to the midpoint now, so that's positive. And we did get an extreme negative reading with the MACD, but now it's positive above its moving average. So all of our oscillators, short, intermediate, and long term, are now going up and they're above their moving averages. So the momentum across all the different time frames is now positive. The Copic curve, another momentum oscillator, is also positive. The Sean trend meter is improving. The money flow going up, could be getting ready to get to this extreme positive reading here, but it's positive for right now. And we're above 50 and going up with the ultimate oscillator. We're above the moving average with unbalanced volume. That's showing an improvement. The bullish percent index, which really was showing some strength before we saw it in price. This was earlier last week, Tuesday and Wednesday. This really started to go up, even though price was, I mean, we had that big gap up on last Wednesday, but then spent the rest of the day coming down. This was still registering strength on that day, and it's continuing to go up. So this is actually quite positive. And we're coming up, but still below 50 with the NYSE bullish percent index, and we're starting to get above this extreme level with the NASDAQ 100 bullish percent index, but we could still possibly go higher than where we're at right now. And we're turning back to positive with the intermediate and short-term RSI. We're back above 50. This is one of the concerning things that we're keeping an eye on. This is a ratio between the SPY and staples. And when the SPY is outperforming, that's when we see this ratio going up. When staples are outperforming, which are more defensive, toilet paper, toothpaste, that's when this ratio goes down. And at the end of 2021, that's when we saw this really start to go down before the S&P started to go down. This topped out in December of 2021. We hit an all-time high in January of 2021, and then we went down after that. We're watching a similar type of thing here, but this ratio is improving. It's trying to come back up here. Now, we could negate this if we see more follow through to the upside, but we don't know if that's going to happen. All we can go with is what we see right now, and this is still concerning to us. And the mass index, the first signal is pretty much gone away. We're now generating a second signal here. When it goes back down to this red dashed line, that's a signal. And we've been going up, which caused this to cross its different criteria. So is this now signaling a reversal to the downside? We don't know, but that's, if you look at this in the context, that's what we would take away from this. But the next chart is producing a buy signal. This is the Pring bottom fisher. And we crossed over last week, and this continues to be a pretty valid buy signal for right now. But I never use this previous chart, the mass index, or the Pring bottom fisher by themselves. We always need confirmation from other charts. And we're still holding up okay here with our support levels, with the pivot points. We're still below this P here. It would be more positive if we could break above that. And that's at about 55.75. But we lost this S1 support level. We were able to get that back, and we've been maintaining price above this S1 level and actually improving. So this is looking more positive, but it would actually turn positive if we get above the pivot point, which is the P. And we're showing some improvement here with our trend, looking at the Chaikin Ashi with the open candles. That's positive. We're turning to black now and pointing up with the Kegi chart. That's positive. The Renko has a new open box here. That's positive. And the three-line break is positive. So all of our different trending charts are now switching back to positive. And we had just enough of an up move getting up to 55.50 to put in a new X here. See, this is the box that I was talking about, where it looks like a big P here, but then we spent a lot of time in this boxed area, and we're trying to see if we can break out above that. We're not out of the clear yet. We still have these other negative areas to get above. So that's why I say we're at the top end of this range. And we've been at the top end of this range now, but we're getting even at the more top part here. If we can get back above these zeros and show some improvement here, that would improve this chart as well. And it's signaling a triple top breakout because we've now tried 3 times to break out here. Long-term chart, a little bit above the green line here with the 150 period moving average study. When we drop below this, that's when we're looking at extreme negative. And we are seeing some improvement with the 200 period moving average study. And this is what was debated, but I'm saying there's no debate here. This is a valid signal where we hit a real low around April 10th or 11th and then we have 10 trading days after that to get up to this red line. We did that, and that happened on Thursday. And this is usually very positive going forward for the market. And it's a long-term bullish signal that's just been triggered, the Zweig NYSE Breadth Thrust. And we're still positive in the short term across all the different indexes. We're negative when we look at the mid caps, small caps, and now the NASDAQ 100 has dropped back to a long-term downtrend. And when we look across the different types of assets, we're still positive with bonds based in the short term. We're negative in the short and intermediate term with commodities. The dollar is still negative across the board on all time frames. And we saw tech and staples, which that's kind of encouraging. Staples is more defensive, and tech was down just a little bit. So we didn't really see an awful lot of follow through or conviction here when we look at the different sectors. We want discretionary, tech, and communication. Those are the three big growth areas. And we also want the financials to hold up pretty well. When they do better, the overall market tends to do better. When some of these other areas are doing better, that's when we're usually under pressure, and if not in a decline. Saw some positive signals not long after the open. We got above 17.4 with the NASDAQ to start off with, but then it went down 17.3, 17.2. The S&P did get back down below 5,500 as I showed earlier, and the Dow is back, at least later in the day, it dropped down below 40,000. And we are in a downtrend with the Dow, and we're hitting the underside of this pivot point here, and that could be providing overhead resistance. We're still positive though with the Elder's Impulse system with the diamonds. We're in a downtrend with the NASDAQ, but we're positive in the short term when we look at the Elder's Impulse system for the NASDAQ. Trying to bounce back up here with the NASDAQ 100, but we are in a downtrend here. But we're still positive shorter term with the Elder's Impulse system for the QQQs, which is the ETF for the NASDAQ 100. The momentum for the NASDAQ 100 continues to be positive as measured by the PPO. And small caps just not doing all that well. They were up a little over a third of a percent, but they were the first to go into a downtrend. And then we look at the other small cap index, the Russell 2000. It's trying to improve. We're above 50 with the RSI, and the short-term momentum is positive, but we're in a longer-term downtrend. We're still positive, though, with the Elder's Impulse system. For the small caps and mid caps, we're not far behind going negative after small caps. Just not looking all that great right now, but on a short-term basis, they continue to be green, and that's positive with the Elder's Impulse system. We're still below both the moving averages with the Wilshire 5000, and we're in a downtrend. And this other broad market measure, we're also in a downtrend with the total US stock ETF. We are still coming down here. This could be positive. The staples are underperforming tech with this ratio. And that's what we want. We want this to continue to go down if we're more positive. But the bigger picture is that staples were outperforming tech, and that's why we're seeing an uptrend with this ratio. The financial sector, not quite back up to its 50-day moving average yet, but still in a longer term uptrend. The FANG index, which just generated a death cross, these are the big stocks, Facebook, Apple, Amazon, Netflix, Google. Right when we generated this death cross is when we came back and we're above both of these lines. So if we could see more strength here, that would possibly negate the death cross that we're seeing. And Apple was up 0.41%, but in a downtrend right now. And Amazon's in a downtrend. It was down 0.68%, coming back above the 50-day moving average, but Microsoft's in a downtrend. Google is in a downtrend, trying to deal with its 50-day moving average. Meta was up 0.45%, but not back up to its 200-day moving average. Nvidia is in a downtrend and declined over 2%. Tesla was up a third of a percent and trying to get back up to its 200-day moving average, but in a downtrend. And Netflix, it's still setting another new all-time high. Out of all the Magnificent Seven stocks that I track, or Magnificent Eight, Illustrious 11, the ones that I track here, Netflix is the strongest. It's breaking out to new all-time highs. Seeing more of a neutral reading now when we look at US versus world stocks. We're kind of in this middle area, and we're leveling off with the longer term correlation as well. This is a weekly chart. I wanted to show it because I think I didn't show this for the video for Monday. This is the gold to SPY ratio. Now, if you really like gold, you don't like what's happening right now. If you're more positive on stocks, you like what's happening here. But this is a weekly chart, and when this is coming down, that means gold is underperforming the SPY. Well, we came up and we set a high back in 2016, and then we trailed off. Then we came up in 2020 during the COVID crash, and we set another high here. Well, there's a trend line going from this high to this high, which is extending down. And last week we came right up to this trend line again, and we've been going back down. Now it climbed a little bit on Monday. But if we break above this yellow line, then that will mean the gold is outperforming SPY, and we've broken this downward trend line. But this could also be acting as overhead resistance with this ratio. And if we continue to fall, that would be more positive for stocks. But it's harder to use this chart on a day in and day out basis because it's weekly. And what we're seeing after Monday is going to be completely different than what we see after Friday when this chart actually completes being drawn. And oil is getting back down into the lower end of the 60 range. We're still in a downtrend with the dollar and below 100. We're coming down here. We're dealing with the 200-day moving average with the 10-year yield. And we're going up with the 10-year based on price. And we're back to being inverted for the second or third day now here with the 10 to the 3-month yield curve. We're in this red area. Where the 10 to the 2-year, it's still doing okay. In fact, it's getting steeper. We're seeing that line going up a lot more, where this line's actually coming down. Then we are holding up okay here with our growth to value ratios when we look at the Qs to S&P, discretionary to S&P, and large cap growth to large cap value. So we're improving with the large caps, mid caps, and small caps, even though all of these declined slightly on Monday. This is also positive. We're still going down. This is meaning that in the short term, staples are underperforming the S&P, and this is possibly setting a spike. But we don't know if it's a spike at the time because we will only know that by hindsight. Because there are other times when it looked like here we spiked and we're going down, here we spiked and we're going down, only to have it go up more. So that's what makes this chart frustrating because we can't use it more in real time. We can just look back and go, oh yeah, that was a valid spike. That was a valid spike. All right, so what's our outlook for Tuesday? We're positive in the short term, where we continue to be, excuse me, negative in the intermediate and long term. And we're going to get some heavy duty earnings reports this week from Microsoft, Meta, Apple, and Amazon. And we're going to get this is not a real big mover here, the advanced international trading goods, as well as retail and wholesale inventories, the FHFA housing price index, the S&P Case-Shiller home price index. So we're getting some housing data on Tuesday. Consumer confidence could have an impact on the market. And then geopolitical things, there's still a war between Russia and Ukraine. There's still things going on in Israel, but the market's mostly fixated on what's coming out of the White House these days as far as the tariffs and the trade wars. Here's the economic calendar. We're going to get some pretty heavy data. With GDP, that's the first reading that we're going to get for the first quarter. And there's a mixed picture that we're seeing. If you look at the Atlanta Fed forecast, we're negative. If you look at the New York Fed forecast, we're positive. So it's like, okay, what's it going to be? So this could really be kind of a big deal, as well as the employment cost index. And then we're going to get a major inflation report coming out with the core PCE. And then we'll get jobless claims on Thursday, as well as another major report, the ISM manufacturing, and then another really big report, the employment situation on Friday. So you can see why there was no reports released on Monday and why the market said, let's take a 3-day weekend here. And even Tuesday's not that influential, but starting Wednesday, we're going to be hit with some pretty heavy stuff, not counting what may come out of the tariff and trade war news arena. Here's also a look at the economic calendar for the week. We are positive for April 29th, though. We're beyond options expiration now. We're getting near the end of April, where we're positive with the Dow, S&P, and NASDAQ. And we do see some positive seasonality when we look at the green dashed line. That's the post-election year, where it tends to be better during that, well, during times of the post-election. But when we take all the years together, we actually see some negative action going into the end of the month. but we really haven't been following seasonality all that close. It's been short-term emotional freak out or euphoria that's been driving things. So we're still negative here with our long-term growth to value ratio. That's still in a downtrend, and we're negative with the discretionary to staples ratio. The moving average studies, now we're positive in the short term, but we're still below 50 with the 50, 100, and 200 period moving averages. And the special K chart, which I just showed in the deep dive video over the weekend because we don't get many signals, that continues to be negative. And we're still looking fairly positive here. Our three smart money indicators are positive. We're positive with the S&P and McClellan oscillators and summation indexes. The bullish percent indexes are positive. The swing and trading oscillator, the parabolic SAR, the momentum across all the different time frames continues to be positive. The ease of movement maybe a little too positive there. The money flow, the ultimate oscillator, and the vortex are positive. The financial sector still hanging on to a long-term uptrend there, and the momentum for the Nasdaq 100 is positive. And then this mass index, not sure what to make of that, but at the same time, we're getting a buy signal from the Pring bottom fisher. Okay, so what's our conclusion? Really no changes here because we didn't see much of a move in Monday's session. We're still positive in the short term, negative in the intermediate and long term. We are improving. We're wondering, can we break out of this range? Intermediate term, we're negative, but really showing some signs of improvement. And in the long term, we're still negative. Not only are we in a downtrend, but we're still below the 200-day simple moving average. Thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.